Hello, everyone. Today is August 5th, 2024. This is your Northbound Wealth Podcast, weekly market insights. Here's the headline: Fed goes dove and investors retreat. So stocks fell broadly last week as investors looked past the upbeat Fed comments and focused on disappointing corporate reports and weaker than expected economic data, particularly in the labor market. You'll see that the Dow Jones Industrial Average lost 2.20%, while the S&P fell 2.06%. The NASDAQ Composite Index dropped 3.35%. By contrast, the MSCI EFA Index, which tracks developed overseas stock markets, gained 0.19% for the week through Thursday's close. It's a volatile week of trading. Stocks were under pressure early in the week as investors appeared to focus on the Fed's meeting, which ended on Wednesday. It was a big week for second quarter corporate reports, with 5 of the 10 largest names in the S&P 500 by market cap reporting numbers, but attention was mainly on the Fed's meeting. Stocks rallied on Wednesday when Fed Chair Powell indicated that September interest rate cuts were on the table. And he said that in quote. But selling picked up on Thursday, last week, as investors their attention quickly shifted to disappointing corporate reports and weak economic data, also coupled with high interest rates by the Fed not cutting until September. Friday morning's disappointing June jobs report raised even more concerns about the economy's strength. The NASDAQ ended the week in correction territory, down more than 10% from its recent all-time highs. So on my blog, on my website, I've got weekly market insights, major index returns, the summary of those, thanks to Y charts. Thank you guys for doing that. Dow Jones Industrial Average year to date is up 8.19%. MSCI EFA Index is up 7.08% for the year. NASDAQ Composite is still up 15% for the year. And the S&P 500 is up 15.10% for the year. Now, today being Monday, it was a 3 to 4% down day, depending on which index you're looking at. So you got to bring that down a bit. So over the past 1 year trailing, though, we still need to keep in mind that the Dow is up 15.57, MSCI is up 11.04, NASDAQ 21.3, and the S&P 20.80. So we've had a nice run. This is a standard correction, a typical correction. It just doesn't happen as much as we'd like to admit. The last time these types of down days and volatilities happen is back in 2022. The 10-year Treasury note, the 10-year rate is at 3.8%. 3.8%. That's down quite a bit, about 14% from the 1 month. Over the last 3 months, down 17.03%. And the 1 year change is about down 6.86%. So we're looking at a 10-year note print a month ago that was at 4.43%, 3 months ago, 4.58%, and then 1 year ago, 4.08%. And thank you, Y charts, for that data all the way up through August 3rd, 2024. Economic concerns. So fresh economic data suggested weakening manufacturing, construction, and employment outlooks. On Friday, the Labor Department's July jobs report showed a sharper than expected job growth slowdown and an unemployment uptick to 4.3%, the highest rate in 2.5 years. At Wednesday's Fed press conference, investors welcomed Powell's unusually candid and upbeat comments. However, as the week progressed, investors started questioning whether the Fed was misreading the economy and moving too slowly and adjusting interest rates. As of Monday, August 5th, the market's continued sell-off is indicative that the Fed is late in beginning the interest rate cutting cycle. However, a near-term stock market correction has been expected, long overdue, and the selling has been orderly over the past 2 weeks, with follow-through seemingly to take place starting today. So this week, key economic data: Monday, ISM Services Index, Fed official Mary Daly speaks. Tuesday, international trade in goods and services, Treasury buyback announcement. Wednesday, consumer credit, EIA, petroleum status report. Thursday, jobless claims, and the federal balance sheet. This week, notable companies reporting earnings. Tuesday, Amgen, Caterpillar, Uber Technologies, and Airbnb. Wednesday, the Walt Disney Company. Thursday, Eli Lilly and Gilead Sciences. So we'll be tracking that information for you. And here's your tax tip of the week. Is it time for a paycheck checkup? There's no better time to check your withholding status and make sure that your paycheck accurately reflects the taxes you should be paying. This paycheck checkup. They're a great practice when something happens in your life that may change your tax status, such as getting married or getting divorced, having a baby, getting a new job, getting a raise or promotion at work. You can also adjust your withholding status if you want to change the tax withheld due to other circumstances. Other factors that can also be checked during your paycheck checkup, such as how much you contribute to your health insurance retirement plan. These expenses can also impact your tax liability. And again, this information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. Stay tuned for the next side. We got a lot of information for you. Hope you enjoy the show. Hello, everybody at Northbound Wealth Management. We want to take a moment to address the recent market volatility and provide some insights into what's happening and how we're seeing events unfold during this time. As you may have noticed, global markets have experienced some declines recently. Japan's Nikkei 225 index was down over 12% on Monday, and the U.S. stocks opened down 4% this morning. The Dow Jones Industrial Average, NASDAQ Composite, and S&P 500 have all seen drops, which were driven by a combination of factors. The first being the weak jobs report. Last week's disappointing July jobs report from the Labor Department has raised concern about the strength of the U.S. economy, although there's been some talk that Hurricane Beryl may have influenced the numbers a bit. Number two, tech earnings. Recent second quarter corporate profits and reports from major tech companies have disappointed Wall Street, so they're not in line with expectations. Number three, seasonal trends. Historically, late summer through early fall are challenging months for the market, particularly in presidential election years. Number four, Federal Reserve's actions. The Fed's decision at its July meeting to maintain interest rates at their current levels has added to investor anxiety. I would say that's probably one of the top issues in my playbook is the Fed is late to lower rates. Number five, yield curve inversion. The yield curve remains inverted, a phenomenon that often precedes economic slowdowns, but the yield curve has been inverted for a very long time, well over a year and a half. So it's not a huge concern if it can get back to its to not being inverted in proper relationship. Despite these challenges, it's important to remember that the market corrections are a normal part of investing. This one was an overdue correction. It was a long time coming. We could all see it coming. We just didn't know when exactly it was going to happen, and it did. And it is happening. So a correction is a decline of at least 10% from a recent high. At times like these, it can be best to manage your exposure to financial media, which often sensationalizes market movements. Instead, focus on the long-term strategy we have in place for your investments that considers your goals, time horizon, and risk tolerance. And remember, we anticipated that there would be periods of volatility. For those of you who have any concerns, we're here for you. In the meantime, here are a few key points to keep in mind. Number one, behavior over market movements. So keep your focus during periods of market volatility. Staying disciplined and sticking with your investment strategy is crucial. Number two, positive earnings. The net profit market for the S&P 500 for the second quarter of 2024 is 12.1%, which is stronger than the first quarter and above the 5-year average. Number three, interest rates. The market is anticipating a series of interest rate cuts by the Fed, which could start as early as September. Okay, and that would be a catalyst for the market. We are continuously monitoring the situation. We'll keep you informed of any significant developments. Thank you for your trust and your confidence in our firm, and we're committed to helping you pursue your financial goals, even in challenging times. If you are a client, if you're not a client and you're interested, give us a call. 317-399-1107. We'd love to chat with you about your investment portfolio allocation and the risk tolerance that you have, some of your goals and objectives, things like that. Stay tuned for the next segment. Hey everyone, this is Brent Foster, and I'd like to go over the housing market to see how it's shaping up because it has stock market implications as well as, what companies to invest in like Lowe's or Home Depot or the home builders and stuff like that. Also, a lot of people, net worths are tied up in real estate. So it also helps with understanding where sentiment is at. as it relates to people buying and selling homes and moving, and where are they moving to? What states maybe have some of the best economics, or what areas of the country have the best economics for people and opportunities. So this data is according to Redfin, or United States housing market. So let's look at an overview. So what is the housing market like right now? So in June 2024, US home prices were up 4% compared to last year, selling for a median price of $442,525. On average, the number of homes sold was down 12.1% year over year, and there were 461,727 homes sold in June this year, down 525,571 homes sold in June last year. That's not good. The national average 30-year fixed rate mortgage rate is at 6.9% and up zero point 0.2 points year over year. So, what does this mean? The direction and pace at which home prices are changing are indicators of the strength of the housing market and whether homes are becoming more or less affordable. The median price of a home in the United States is currently $442,525. So the top 10 metros in the US with the fastest growing sales price: Akron, Ohio; Irving, California; Arlington, Virginia; Honolulu, Hawaii; Charleston, South Carolina; Enterprise, Nevada; Toledo, Ohio; Washington, D.C., Detroit, Michigan; and Montgomery, Alabama. U.S. housing supply. So are there enough homes to sell to meet buyer demand? So in June 2024, there were 1,775,865 homes for sale in the United States. That's up 13.7% year over year. The number of newly listed homes was 592,674, and that's down 2.6% year over year. The median days on the market was 32 days, so they're moving pretty quick. That's up 3 year over year. The average months of supply is 3 months. That's not up, it's flat on that one. So, what does this mean? The direction and pace at which housing supply changes indicate whether the options for buyers are increasing or decreasing. They can also indicate whether homes are lingering on the market or being sold faster than sellers are listing them. There are currently 1,775,865 residential homes for sale in the United States. So what's demand like? U.S. housing demand. Is it a competitive, or how competitive is the market? In June 2024, 35.1% of homes in the U.S. sold above list price. That's down 4.5 points year over year. There were only 19.8% of homes that had price drops. That's up 14% of homes in June of last year. There was a 99.9% sale to list price, down 0.39 points year over year. So what does this mean? Homes that sold above list price likely receive multiple offers. A high or growing percentage of home selling above list price indicates that the housing market is competitive and bidding wars are becoming more common. A low or shrinking percentage of homes selling above list suggests that the market is becoming less competitive. So the top 10 most competitive cities in the United States: number one, this is according to Redfin again, number one, San Jose, California. Then we've got Cary, North Carolina; Richmond, Virginia; Seattle, Washington; Lakewood, Colorado; Littleton, Colorado; Omaha, Nebraska; Sacramento, California; Anchorage, Alaska; and Tacoma, Washington. So U.S. migration trends. So where are people moving to and from? Nationwide, 25% of home buyers searched to move to a different metro between April 24 and June of 2024. So April to June. The top 5 states home buyers searched to move to were Florida, North Carolina, Arizona, South Carolina, and Tennessee, while California, New York, Illinois, Washington, and Massachusetts were the top 5 states home buyers searched to move from or move out of. Of all the major U.S. metros, Sacramento was the most searched for destination among home buyers looking to relocate between April and June of 2024. Next came Phoenix, Sarasota, Cape Coral, and Orlando. Los Angeles was the most searched for destination among home buyers looking to leave. followed by New York, San Francisco, Seattle, and Washington. So the top 10 areas people are moving to: Sacramento, Phoenix, Sarasota, Cape Coral, Orlando, Myrtle Beach, Las Vegas, San Diego, Tampa, and Salisbury. Then the top 10 areas people are moving from: Los Angeles, New York, San Francisco, Seattle, Washington, D.C., Chicago, Illinois, Boston, Philadelphia, Denver, and Hartford, Connecticut. So very interesting housing market data, and I think it's appropriate to tap on that. And then we'll transition to the next, I think, worthy article to point out as far as buying is concerned. Buying and selling, that is. All right, stay tuned for the next segment. So this is an article written by Chen Zhao. We're in the middle of the buying and selling season in real estate. Chen Zhao leads the economics team at Redfin, where she produces research on the housing market for public and internal audiences. Previously, she was an executive director leading housing finance and financial markets research at the JP Morgan Chase Institute. So I think it's appropriate to tackle right now, given where we're at in the middle of the summer in July. So the White House has proposed a national rent control policy, which sounds appealing in theory, but eventually increase costs for renters because it would exacerbate the supply of shortage. If the policy were to go into effect now, it would impact some of the metros in the Northeast, Midwest, like Boston, Washington, D.C., Chicago, Minneapolis, which are all seeing rents rapidly rise. The White House announced a series of new actions aimed at housing affordability today, which would be July 16, 2024, a couple days ago, asking Congress to implement a 5% cap on rent increases for corporate landlords for existing units, repurposing some public land to build affordable housing units, distributing grants to rehabilitate distressed housing, build more affordable housing, and revitalize neighborhoods. So caps on rent hikes are appealing politically to renters in the short term because they limit rent increases, but they only make housing affordability worse in the long run because they exacerbate the supply shortage. We'll explain later. So the root of the housing affordability issue is a severe shortage of housing units. Estimates range from 1.5 million to 5.5 million or more. The best way to address the lack of affordability in both the for sale and rental markets is to build more housing units. For developers to be incentivized to build more housing units, they need to feel like that they'd be able to make a profit. If rent increases are capped below what supply and demand would otherwise dictate, then builders have little incentive to build more housing units, obviously. The result of caps on rents increases is lower rent in the short term, but worse shortage in the longer term, which would worsen affordability. Experiences like that of Berlin, Germany should be instructive for the US. This proposal expressly carves out exemptions for landlords with fewer than 50 units. So those are like the mom and pops, new construction, and instances where there was substantial renovation rehabilitation to address the disincentive for landlords to invest in building or renovating units. However, it does not specify how long the new construction exemption is good for. That's a problem, right? After the first year, a newly constructed unit becomes an existing unit and is likely to fall under the rent cap rule. Some may argue that the cap on rent hikes wouldn't be binding because nationwide rent growth is largely flat right now. However, that overlooks metro to metro variation. Many metros in the Northeast and Midwest, like we talked about, are experiencing rent growth greater than 5% year over year, and the national rent growth vastly exceeds 5% recently during the pandemic. The other proposals aimed at increasing housing supply in this announcement only nibble at the edges, but are a step in the right direction. President Biden's other proposals, which include using federal land to build more housing units and giving grants to communities to build them, should help increase supply, but they don't go far enough to entirely solve the supply problem because they wouldn't create enough new units. The federal government could make a much better difference or bigger difference if it were to pressure localities to allow for denser housing. That pressure can be applied by tying federal funding to local regulation, similar to how the rent cap proposal is constructed. Stay tuned for the next article and segment on housing and real estate. Hope you found this helpful. Did you know about the new filing requirements for small business owners? I put this out on my blog, July 17th. If you are a small business owner or plan to be one, you should be aware of a new reporting requirement. The Corporate Transparency Act, or CTA, passed in 2021, changed beneficial ownership rules, which is expected to impact 32 million businesses in 2024 alone. That does include me, by the way. Suppose you own more than 25% of a company, directly or indirectly. In that case, you must be included in the company's beneficial ownership information, or BOI report, filed with the Financial Crimes Enforcement Network, or FinCEN. This report includes your name, date of birth, address, and other identifying information. Your ownership in the business needn't be direct. The report can include stockholders, partners, limited liability company members, directors, and owners. Congress passed the CTA to boost its efforts to combat money laundering by increasing the reporting obligations of shell companies and other corporate entities that bad actors use to shield the identities of their underlying owners. We're providing this update so that you can stay up to date on current legislation. It's not a replacement for real-life guidance, which should come from your tax, legal, or accounting professional. However, if you're struggling to find more detailed information, we might be able to help. We can introduce you to a tax or legal professional who can help discuss some of the new rules and share some insights. Types of businesses that may be impacted. So, the new BOI rules apply to a wide range of business types, including LLCs. The report must also include control persons who directly or indirectly control business decisions, even if their ownership falls short of the 25% threshold. There's some exemptions. There's 3. So sole proprietorships and general partnerships typically don't need to file. Federally regulated businesses, such as publicly traded companies, financial institutions, and insurance companies, may be exempt. Businesses within a minimum of 20 full-time employees, more than $5 million in revenue, and a substantial footprint in the U.S. may also be exempt. Compliance deadlines. For businesses formed before January 1st, 2024, the deadline to report beneficial owners, if they meet the ownership threshold, is January 1st, 2025, so you have until the end of the year. For businesses formed after January 1st, 2024, new companies established after the start of this year must report within 90 days of receiving an approved state business registration. Reporting obligations can become complicated if you wholly or partly own a company with a substantial stake in another company, especially if your ownership adds up to a stake of more than 25%. Beneficial owners don't necessarily need to file this report directly if the company in question files it appropriately. Currently, the CTA does not require annual reports. However, it does require updates when there are changes to previously reported information. Updated reports are due within 30 calendar days after the change. Potential penalties for not filing. So, the smallest businesses are not familiar with the new requirements. A 2024 survey of National Small Business Association members published in November showed that almost 47% of respondents had no idea what the CTA was. Another 25% said they had heard of the law but didn't know whether they were required to report. This lack of familiarity with the law can have negative repercussions. Not filing ownership information to FinCEN can carry criminal and civil penalties. Willful failure to comply can also lead to fines of up to $591 a day for each violation. Don't do it on your own. These rules can be overwhelming, so we hope that this brief overview helps you think about your corporate compliance and strategic initiatives. For simple questions, you might find some answers on the Financial Crimes Enforcement Network website under Beneficial Ownership Information. If you're confused about where to start, please reach out. We're happy to help. And this data is from the Federal Register, this information is from the Federal Register 2024, Morgan Lewis, April 19th of 2024, and the Wall Street Journal, February 8th, 2024. Stay tuned for the next segment. So at Northbound Wealth Management, we have 6 things I'd teach my college kid. You ready for this? Number 1, the value of summer jobs and internships. Summer jobs and internships provide valuable career building skills such as networking, critical thinking, and a strong work ethic. Number 2, understand your paycheck. Get to know the details of your paycheck. Every line item offers a learning opportunity about your financial status. Specifically, how much taxes are you going to pay? Number 3, budget brilliantly. Budgeting isn't about limiting what you spend. It's about empowering your income to do more with a clear purpose. So telling your money what to do versus it telling you how you can spend it. It's kind of a Dave Ramseyism on that one. Number 4, save early, save often. Start your savings journey early. It's amazing how a small amount today can grow over time. It's called compounding interest. It's amazing. Number 5, use credit card strategically. So debt. A credit card is a financial tool. It's not extra cash. Understanding this can help manage debt. And number 6, network, network, network. Take advantage of campus events, industry conferences, and social platforms to build a strong network that could help you in the long run. You heard it here. 6 things that can help your college kid. Northbound Wealth Management. Welcome to the Northbound Wealth Podcast. All opinions expressed by me, my co-hosts, or my guests are solely our own opinions and do not reflect the opinions of Northbound Wealth Management. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, and tax advice or as a solicitation to offer or buy any securities. Clients of Northbound Wealth Management may maintain positions in the securities discussed in this podcast.